Hi friends, welcome back to Amazon World, and in this video I'll be taking the portion partnership accounts. So let's go straight to our content. So let's see what is partnership.
The relation between persons who have agreed to share the profits of a business carried on by all or any of them acting for all.
What does that mean? Let's say, for example, if 2 or 3 people together commenced a business. So the profit which they get from this business will be shared among them either equally or on the basis of the capital which they have contributed or which they have invested, right? So in our example, we said about 2 or 3 people who commenced the business, right? So it is the relationship between these people what we call as partnership. So we said about 2 or 3 people, right? So it is not mandatory for each and every person to be active. Either any one of them can act for all, or everyone can be active also. So this is what we call as a partnership. Now we are going on to the features of partnership. Main important 3 features of partnership. That is, first, at least there should be 2 members. Okay, minimum 2 members is mandatory. Then comes unlimited liability of all partners. What does it mean by unlimited liability? Unlimited liability means if any debt occurred and the partners doesn't have money with them to pay that off, they have to sell their private property and have to pay off the debt, right? So that is what we mean by unlimited liability, and there should be an existence of a business. So that is what the 3 important features of partnership.
Okay, so I'll be not explaining each and every point in this video, but I'll be touching all those portions which is very important for us, and some points which we have to keep in our mind while we are studying this. I guess almost every one of you might know what is a partnership deed. Okay, so I will be not explaining what is a partnership deed, but instead I'll be now explaining what are the rules which we have to apply during the absence of such partnership deed. Fine. So let's go to the points.
So the first point is about profit and loss contribution. In the absence of partnership deed, we have to share profit or loss or whatever it is equally, irrespective of their capital contribution. What does that mean? For example, let's say A, B and C were there. A contributed 1 lakh, B contributed 1 lakh and C contributed 2 lakh. Okay, so on the basis the ratio should be what? 1:1:2. But if there is no partnership deed, then they are to share the profit or loss equally. If there is already an agreed ratio, it should be there inside the partnership deed. Next point is about interest on capital. During the absence of partnership deed, interest on capital is not to be given to the partners. Partners are not entitled for the interest on capital. But let's say if the agreement does provides, or if the agreement does mentions about this interest on capital, then it should be given only out of the profits of the business. What if the business have loss? Then there is no need to give interest on capital. Interest on capital need not to be allowed. Fine. Next we'll be talking about interest on drawings. It is simple. If it is not mentioned in the partnership deed, then there is no need to give interest on drawings to the partners. Next point is about interest on partners loan to the firm. So for explaining that, I'll be explaining this point with the help of an example. Let's say Amit, Neha and Raja are partners of a firm and they are contributing 1 lakh each as capital. But the firm was in need of 2 lakh again. So since Raja was from a rich family background, Raja thought to give rupees 2 lakh as loan to the firm. Fine. Now the firm has to give interest to Raja. Let's say in the partnership deed there was no point in regarding the partner's capital, interest to partner's capital. So what will happen in such cases? During the absence of partnership deed, what we have to do is that the firm has to give 6% interest per annum on the loan which was provided by the partner.
6% interest has to be provided to Raja if interest on partner's loan to the firm is not present in the partnership deed.
Next point is no partner has the right to salary. If the partnership deed is not saying anything about salary or remuneration to partners, then there is no right for partners to get the salary. In the absence of an agreement, if interest and salary is to be paid to a partner, it should be only be paid from the profit. That is the other point you have to keep in your mind. Okay, so next we are going to talk about accounts of partnership. So in accounts of partnership, what are the accounts which we prepare in partnership? They are trading account, profit and loss account, profit and loss appropriation account, and partners capital account. Okay. Now let's see profit and loss appropriation account. So this is the pro forma of my plus 2 textbook. I will explain with the help of this pro forma. Okay, so now let me explain this briefly. That is, the profit which we get from trading and profit and loss account will be transferred to the credit side of profit and loss appropriation account. If it is net loss, then we'll transfer it into the debit side of it. And interest on drawing, we'll talk about it later. So now let me explain interest on capital. That is, partners will bring their capital to the firm, right? So the firm has to give them interest. If they are planning to give, the firm is planning to give interest, then it should be shown on the debit side of profit and loss appropriation account. And in the case of interest on drawings, means the partners might take something from the firm for their own personal use. So that is what we call as drawings, right? So the partners has to pay interest to the firm, so it will be shown on the credit side of the profit and loss appropriation account. And partner salary, partners commission, reserve, if there is any transfer of reserve happen, it will be shown on the debit side. And when we finally total it up, if the balancing figure is going to appear on the debit side of profit and loss appropriation account, then it is profit. Then if it is going to be appeared on the credit side, then it is loss. So whatever it is, even if it is loss or profit, it should be shared among the partners in whatever profit sharing ratio they have agreed upon. So I guess profit and loss appropriation account is now clear to you. So I'm going for the explanation of methods of maintaining capital accounts. Okay, so there are two methods of maintaining capital accounts of partners. So one is fluctuating capital method and the other one is fixed capital methods. Even though these portions are not there in our CMA textbook, I'm just explaining it for your information. Okay, so the first one is fluctuating capital method. So what is the feature of fluctuating capital method? There will be only one account which prepared under this method. Okay, so all adjustments such as drawings, interest on capital, salary, commission, share of profit and loss will all be shown under this one account.
As a result, the capital balance of a partner at the end of the year will be different from that at the beginning of the year.
Since the capital fluctuates from time to time, we call this method as fluctuating capital method, and it is also called as floating method. Next, I will be explaining the pro forma of partners capital account. The very first thing we write in a capital account is balance brought down. It can be cash or bank. It is the portion what the partner has contributed towards the firm. Fine. And then next comes what? Assets. Like sometimes partners also brings some kind of fixed asset, furniture, machinery. Okay, sometimes partners used to contribute asset as well. Then comes cash and bank, like additional capital, if any. Then interest on capital, that is it is the interest which is given to the partners by the firm. Then comes salary and commission and all. Then in the debit side of the capital account, we used to write drawings. It can be of cash and kind and interest on drawings as well. The other thing which we write in debit side is the share of loss. That is, from the profit and loss account, we'll get a net profit or net loss, whatever it is. So we will transfer the net loss to the debit side of the capital account and profit to the credit side of the capital account. Then what we do is we used to total the both sides, and then we'll see where the mismatch came and we'll write it as balance carried on, and this amount will be written in the balance sheet. Okay, so now let's start with fixed capital method. So what is the difference between fixed and the fluctuating capital method is, under fixed capital method we will draw two accounts, that is capital account and current account. So let's read this. The original capital invested by the partners remains fixed unless some additional capital is introduced or capital is withdrawn by mutual agreement. So what does that mean? Okay, so I told you that we will draw two accounts, that is capital account and other one is current account. In capital account, we'll only write the initial capital which is contributed as balance brought down, and then we'll write additional capital if any contributed, and then we'll write the withdrawn amount. That is, if any capital amount is withdrawn, then we will show it in the debit side and the balance carried on. Okay, these are the only contents of the capital account. So when will there be a fluctuation in this capital account? If there is any additional capital or if there is only withdrawals happening, just this capital account changes. Otherwise, the capital account won't change. So that is why this method is called as fixed capital method. And you will ask me, so what is the thing which we write in the current account? In current account, we write other adjustments such as drawings, interest on capital, salary, commission, share of profit, all those, everything other than what? Additional capital, initial capital, capitals withdrawn, and the balance carried on. Fine. So this is why we draw two types. So in order to show these kinds of adjustments, we draw a separate account called as current account. Now let's see the pro formas of these. Okay, so you'll be able to see the pro forma of partners capital account. As I told you, we'll write balance brought down, that is the initial capital which has been contributed by the partners to the firm, and then we'll write additional capital introduced as cash or bank or assets, whatever it is, and then on the debit side we'll write the amount withdrawn. If there is any amount which is withdrawn by the partners, we'll write in the debit side of the capital account, and then the balancing amount we'll write as balance carried on. So that is the pro forma of partners capital account. But when it comes to partners current account, we'll write all other adjustments which we wrote in the fluctuating capital account, right? So what are the other things which we have not returned in the capital account? They are the interest on capital, salary, commission, and drawing, interest on drawings, everything else, right? So and also the share of loss and share of profit, we'll all write it in the partners current account. So hope what I explained is clear to you. Okay, so now we'll be going for the explanation of goodwill. So many of you doesn't know what is the real meaning of goodwill. So let's explain goodwill with the help of an example. So we can see Ramu. Ramu had started his own business, his own restaurant, and daily he gets a turnover of rupees 20,000. His friend called as Sonu already had a restaurant, and it was a big restaurant and it already had its own image build up. So per day its turnover was rupees 80,000. So let's take another instance that if Ramu was to start another franchise of Sonu restaurant, he might have get per day turnover as rupees 40,000. But if he start on his own, he will only get turnover per day as rupees 20,000. So you can see the difference, right? What is the logic behind this? If Ramu started his own business, he gets only turnover per day as rupees 20,000, but when he starts a franchise of Sonu restaurant, turnover per day becomes 40,000. So Ramu started to get extra 20,000 from Sonu restaurants franchise, right? So Ramu is getting extra 20,000 benefit. You will be asking me why? Because you can see the difference, right? When Ramu started his own business, he gets only rupees 20,000 per day. But when he starts a franchise of Sonu restaurant, he gets rupees 40,000 per day. Why? Because Sonu restaurant has its own image already built in the society, right? So people, the customers who had already ate from a Sonu restaurant knows the taste of the Sonu restaurant. They believe Sonu restaurant. So they come to the franchise of Sonu restaurant, and thus Ramu gets extra rupees 20,000. So what is the benefit of Sonu? There is no benefit, right? So in order to get, Sonu should have some kind of benefit, right? So Ramu have to give an amount to Sonu as goodwill premium.
Turnover of Mr. Ramu gets by opening another franchise may not be because of him, but because of the goodwill or the image Sonu restaurant have built up over years. So since Mr. Ramu gets an extra amount to his pocket, isn't it only fair if he gives some amount to Sonu restaurant?
So here you will be able to see the difference between a business which newly started and the business which already existed, right? So like if you see the Ramu's two instances, in the first instance Ramu gets only rupees 20,000, and in the second instance he gets an extra 20,000, right? Totally 40,000. So this is because of goodwill. Okay, so let's take another example in order to understand the concept of goodwill in deep. Fine. So Raj and Shyam are partners of a firm like Raj restaurant. They have already started a Raj restaurant, and it has already built up his own goodwill and image. So per day they get a turnover of rupees 80,000. And Mega was their friend, but Mega thought to start a Mega restaurant, a newly started restaurant, and she gets a turnover of rupees 20,000. But if we take another instance, that if let's suppose Mega comes to the Raj restaurant, tells about her interest in joining them as a partner. Okay, so Raj and Shyam supported her, and they admitted her as a new partner. Okay, so Raj and Shyam were actually equal partners before the arrival of Megha. They were sharing the profit and losses in equal.
ratio, that is 1:1. So after Mega's admission, they thought to remain as equal partners at 1:1:1. Okay, fine. So per day they used to get rupees 80,000, and before the arrival of Mega, when they divide this 80,000 between them equally, they used to get, each of them gets rupees 40,000. But after admitting Mega, when they divided this 80,000 into equal shares, each of them gets only 26,667, right? So what happened here? The old partners sacrificed their portion, right? Before the arrival of Mega, they used to get rupees 40,000, but after the arrival of Mega, they only get 26,667, right? So they are sacrificing, right?
All partners are foregoing or sacrificing their portion of profit for the newly admitted partner. Why should the existing partners do this without anything? And there comes the concept of goodwill premium. In order to get this extra amount from business, Mega has to give some amount as goodwill premium.
Okay, so we told about the extra benefit what Mega gets, right? So Mega, we already told about the instance where Mega starts her own business, right? Mega restaurant. So she gets rupees 20,000 per day as a turnover. But when she joined as a partner of Raj and Raj restaurant, she gets now 26,667. So when we subtract 20,000 from the said amount, we'll get 6,667. That is the extra benefit what Mega gets when she joins as a partner of Raj restaurant. Why? Because Raj restaurant already has its own goodwill. So thus when she joins them, she gets the extra amount, right? Now let's see the overall view of admission of a partner chapter.
When a partner is admitted, we will value the goodwill of the firm by using any method.
So this is the very first thing that happens. After admitting a new partner, what we used to do is that we have to revalue the goodwill of the firm. So there are lots of method in order to value the goodwill of the firm. So we will discuss that later. And
a portion of this goodwill has to be brought in by the new partner, which we will call as premium.
okay, so after valuing the goodwill of the firm, a portion of this valued goodwill has to be bought in by the new partner, and this is what we call as premium.
This premium is being shared by the existing partners either in their sacrificing ratio or old ratio. They can either withdraw this amount or can retain it in the business itself.
Said goodwill premium amount which is bought in by the new partner is shared among the old partners or the existing partners in their sacrificing ratio. They can either withdraw this amount or they can retain this amount in the business itself.
There are situations where the previously valued amount of goodwill appears in the balance sheet. When such situation arises, we have to write off this value.
So we'll talk about this portion elaborately later. So now let's come to our study mat. So now I will be following the study mat. So this was all that important points you have to keep in your mind before you go learn admission of a partner. So now let's see the important points which we have to cover from our study mat. So the first point tells about adjustment regarding profit sharing ratio. So now let's see what does it say.
The new partner becomes entitled to a share of future profits which is sacrificed by the existing or old partners in his favor. The sacrifice may be made by one or all of the existing partners.
I've already explained about this before, and now the point you have to stress is that the new profit sharing ratio has to be found out. So okay, after admitting the new partner, we have to calculate the new profit sharing ratio. So either it might have given already in the question, or else we have to find it with our own. Okay, so in order to find the new profit sharing ratio, there are certain points you have to keep in your mind. The first point is that the new profit sharing ratio may be agreed upon by the partners. We already know that after admitting the partner among themselves, the partners among themselves will agree upon a certain ratio in which they are going to share the future profit. The next point is what it might be really confusing for you. So our institution has also provided us with an example so that we'll understand it deeply. The mutual profit sharing ratio among the existing partners may remain unaltered after giving away the new partner's share. That is the mutual profit sharing ratio. What is the mutual profit sharing ratio? That is the ratio between the old partners. The ratio among the old partners may remain constant. There might not be any change in that after giving away the portion of the new partner. It not be much clear for you now, but now let's explain it with the question which is already given in our study mat. The first example, X and Y were partners sharing profit and losses as 3:2. Okay, so X and Y are the old partners, or we can also say them, or we can also call them as existing partners. They are sharing profit sharing ratio is 3:2. Fine. They admit Z as a new partner, there is Z in between. Okay, so Z as a new partner giving him 1/5 share of the profits. Okay, so the profit, the share of profit which is giving to the new partner is 1/5. So that is also clear. That is also given in the question. What should be the new profit sharing ratio? So they are asking us to find the new profit sharing ratio. So the second point told us that the mutual profit sharing ratio or the sharing profit sharing ratio among the old partners or the existing partners may remain constant or remain unaltered. There will be no change in them. May, it is said may, they are stressing may remain unaltered. Okay, after giving away the new partner's share. So let's do that first. So say Z's share is 1/5. It is given in the question itself. Now, after giving away Z's portion, what will be the balance share? That is subtracting 1/5 from 1. We'll get 4/5. So, you'll be asking me what is the logic of subtracting 1/5 from 1, right? So, let's say in when we talk about percentages, the first thing that comes to our mind is 100%, right? So, in fraction, it is 1. Like if we say 75% in 75% in percentage wise, it is written as 3/4 in fraction. So likewise, in fraction, 1/1 is equal to 100%. 1/1 is 1 only, right? So I will explain it in percentage wise, so it will be clear for you. So now let's say Z's share is 20%. Okay, so they are asking us to give the share of Z to him first. So what we does is we subtract 20% from 100%. So the remaining share is 80%, right? Now this 80% have to be shared among the existing partners in their ratio. So that is what I told. The same thing is happening in the fraction also. We are subtracting 1/5, which is the share of Z, from 1. We'll get the remaining portion. Okay, that the remaining portion after cross multiplying we'll get 4/5. So we have to share this 4/5 within or among the existing partners. How are we going to share it among the existing partners? There is no other hint given in the question, right? There is nothing said in the question. So what we are going to do is that we are going to share this 4/5 or this 80% to the old partners X and Y in their old sharing ratio only. How can we do that? Let's see. The old profit sharing ratio is 3:2. So let's divide this 4/5 to X and Y in their old profit sharing ratio basis. So let's see how it is done. So X's old ratio is 3/5 and Y's old ratio is 2/5, right? So let's give 3/5 of this 4/5 to X. So that is why we are doing that. 4/5 into 3/5. That means the 3/5 portion from this 4/5 is given to X. So we'll get 12/25. Likewise, we are giving 2/5 portion from this 4/5 to Y. So we'll get 8/25. Okay. Now Z's share is already given in the question, that is 1/5. So we have to make the denominator same, right? So 1/5 we got X's and Y's new share as 12/25 and 8/25 respectively. So we have to make the denominator of Z's share also as 25. So what we do, we'll just multiply denominator with 5. So only after multiplying denominator with 5 we'll get 25 on the denominator side, right? So I multiplied denominator with 5. So I have to also multiply numerator with 5. If I am going to multiply denominator with 5, I have to multiply numerator also with 5, right? So what will be the Z's new profit sharing ratio? That is going to be 5/25. I hope this is clear to you. So what happened here is that existing partners, the mutual profit sharing ratio between this existing partners didn't change, because we gave that the balance share 4/5 was shared among the existing partners in their old profit sharing ratio only. We gave 3/5 of 4/5 to X and we gave 2/5 of 4/5 to Y. So that is what we are explaining in the second point. I hope this point is clear to you.
The mutual profit sharing ratio among existing partners may be changed by agreement.
don't confuse this third point with the second point. In the second point, we explained that the existing partners sharing ratio, the sharing ratio among the existing partners may not be changed even after the admission of new partner. We already saw an example question there. In the third point, it says that they can change the mutual profit sharing ratio of this existing partners if there is an agreement. If in the agreement it says about that the mutual profit sharing among the existing partners changes, they are going to change it from this to this. If they are going to stress it and given the question, then it's fine, we can do in the that we have to do it as it says, fine. So there is a question, there is also an example question given for this point as well. So let's see what the example question says. P and Q are partners sharing profit and losses as 4:3. So the old partners are P and Q, and their profit sharing ratio, their old profit sharing ratio is 4:3, and R is admitted as a new partner, and Q decide to share, P and Q decide to share the balance of profits equally. So here in this question, they have already given us the hint how are they going to share the profit sharing ratio among the old partners, right? That is, they have first they have already given us the old profit sharing ratio as 4:3, and then they say they are admitting R as their new partner, fine, and they are going to give 1/5 of the share to R, okay, fine. Then they say this sentence, please focus on the sentence, that P and Q decide to share the balance of profits equally. In the past question it was not given, right? In the earlier question they have not given us how are they going to share the profits, right? But in this question they have given us that they are going to share the profits equally. That means the all profit sharing ratio 4:3 has no value in this question. So let's see how this question is being solved. First we are going to give the 1/5 of share to R first. So we subtract this 1/5 from 1, and we have the remaining portion as 4/5, and now we are going to share this 4/5 among the existing partners equally. That is what in the question given, right? So 4/5 into 1/2, 4/5 into 1/2, because we are going to share it equally, right? So equal means half and half. So we shared this 4/5 among the existing partners equally. That is 1/2 share of 4/5 is given to P, and 1/2 share of 4/5 is also given to Q. Now their new profit sharing ratio is 4/10. P and Q gets 4/10, 4/10, and in order to make the denominator same, we multiply the denominator of R share with 2. So we get numerator. If you are going to if you are going to multiply denominator with 2, we have to multiply numerator also with 2. So we get 2/10 as R's share. So now the new profit sharing ratio becomes 4:4:2. We can also short it as 2:2:1. So this is how we do this question, and I hope this point is clear to you.
Okay, if the sacrifice made individually by the existing partners is given, then new ratio should be calculated by deducting the sacrifice from the old ratio.
In some instances, in some questions, they will give us the sacrifice which is done by the existing partners in order to admit a new partner, right? So if the sacrifice portion is given in the question, then we can calculate the new profit sharing ratio by subtracting this sacrificing ratio from the old ratio. Okay, just detect the sacrifice from the old ratio. So they have already given us an example. Let's go through that. A, B and C were partners sharing profit and losses as 3:2:1. So there were 3 existing partners, or you can say 3 old partners, and their old profit sharing ratio is 3:2:1. They are going to admit D as their new partner and going to give him 1/6 of the future profit, fine. So the portion which they are going to give D is 1/6. Now D acquire 3/24 share from A and 1/24 share from B. So they are told us in the question that A has sacrificed his 3/24 share for D, and B has sacrificed 1/24 share to D, right? For their admission of D, in order to give 1/6 of the future profit to D, A and B are sacrificing their 3/24 and 1/24 of share. Okay, so they have given us they are sacrificing ratio, right? Their sacrificing ratio is 3:1. A's and B's sacrificing ratio is 3:1, right? So we can just subtract this 3 by 1, or you can say 3 by 24 and 1 by 24 from the old ratio. What is the old ratio of A and B? 3 by 6 and 2 by 6, right? So 3 by 6 minus 3 by 24 and 2 by 6 minus 1 by 24. So we have to cross multiply it. Only after cross multiplying and making the denominator same can we find the solution to this, or we can find the new profit sharing ratio. Now let's do that. So this is that equation that we are just detecting sacrifice ratio from the old ratio. So now let's see 3 by 6 minus 3 by 24. After cross multiplying it, the last or the end answer we get is 9 by 24. Likewise in B also we are subtracting 1 by 24 from 2 by 6. So we will get what the end answer becomes 7 by 24 after all that cross multiplying. Okay, and it is already given us in the question. And C, about C, so you will see that C doesn't sacrificing anything, right? So 1 by 6 minus nil, because C is not sacrificing anything, so we don't have to subtract anything from this 1 by 6. But still we have to make the denominator same to the new profit sharing ratio, right? So in order to make the denominator of C same with the A's and B's, we are just multiplying the denominator with what? 4. So after multiplying the denominator with 4, we have to also multiply the numerator with 4. So becomes C's share becomes what? 4 by 24. Fine. And when it comes to D, it is already given us in the question that the portion which they are going to give D is what? 1 by 6, right? So in order to make the denominator same, we just do it as how we do it in the C's case. Okay, we are just multiplying the denominator with 4, and if you are going to multiply denominator with 4, we are also we have to multiply the numerator also with 4, and thus the C's new profit sharing ratio becomes 4 by 24. So now we get everyone's denominator same. So the sharing ratio becomes what? 9:2, 7:2, 4:4. So that is the new profit sharing ratio. So we have gone through all cases of new profit sharing ratio, how we are going to calculate new profit sharing ratio in each case. In some case the mutual profit sharing ratio among the old partners remains same. In some cases they says in the question itself that the old profit sharing ratio is not going to be followed in the new as well, after the admission of the new partner as well. And the other cases they might give us a sacrificing ratio, so we have to subtract the sacrificing ratio from the old ratio, and then we have to find the new profit sharing ratio. And I guess this is clear to you. I've already given us what is old ratio, what is new ratio, and what is sacrificing ratio. Just go through that. We have already explained what is this, and I hope it is clear to you now. After going through all this example question, it should be clear to you. Fine. And now let's go to the that highlighted portion. Let's see that. But unless otherwise mentioned, the mutual profit sharing ratio between the existing partners will remain unaltered. In that case, sacrifice ratio is equal to old ratio. What does this mean? I hope you all remember the second point which we discussed about the calculation of new profit sharing ratio with the example question. That is, that case is what? The mutual profit sharing ratio among the existing partners remains unchanged. If that case, yes, this point, what does it say? If the mutual profit sharing ratio among the existing partners remains unaltered, in such cases what happens? The sacrificing ratio, that is the sacrifice ratio, will be equal to old ratio. Now we are going to discuss the second point, that is the adjustment regarding valuation of asset and liabilities. The book values of assets as shown in the balance sheet may not reflect their current realizable values. What does that mean? The values which is shown in the balance sheet may not be the value which we get after selling all those assets and all, right? So similarly, the liabilities included in the balance sheet may fluctuate from their actual position, right? So wherever a change takes place in a partnership business in the form of retirement or admission or death of a partner, or due to change in profit sharing ratio, revaluation of assets and liabilities become necessary. So what does this mean? If there is anything happens like admission, death, retirement, or any change in profit sharing ratio, if these kinds of circumstances happens, then we have to revalue asset and liabilities. So there are actually two ways in which we revalue this asset and liabilities, and that is what we are going to discuss next.
Effect of revaluation are given in two ways.
by incorporation the changes of the balance sheet value and without changing the balance sheet value. So there are two types or two methods in revaluing the assets and liabilities. Okay, so we are going to explain the first one, that is by incorporating the changes of the balance sheet value. So let's see how it is done. So if you are going to prepare evaluation account under this method, the balance sheet values will change. Okay, the balance sheet values will change. So let's see. For decrease in the value of assets, increase in the value of liabilities, provision for unrecorded liabilities. So for these things, we are going to pass the following journal entry. So let's see the journal entry for decrease in the value of assets. So what we do, revaluation account debit to asset account. If the value of asset is going to decrease, then we have to pass the journal entry revaluation account debit to asset account. If the value of liability is going to increase, then we have to pass the journal entry revaluation account debit to liabilities account. If we are going to create a provision for unrecorded liabilities, and then we have to pass the journal entry as revaluation account debit to liabilities account only. The same journal entry which we used to write for the increase in value of liabilities only, that the same comes for the provision for unrecorded liabilities. Now the next journal entry comes for increase in the value of asset and decrease in the value of liabilities, unrecorded assets. So for increase in the value of asset, we have to pass the journal entry asset account debit to revaluation account, because asset is increasing, right? So asset becomes debit. Then for decrease in the value of liabilities, we have to pass the journal entry liabilities account debit to revaluation, because liability is decreasing, so we have to credit liabilities, right? Then for unrecorded asset, we are going to pass the same entry, that is asset account debit to revaluation account. Then comes, if revaluation profit after totaling the both sides, if the amount is going to appear in the debit side, then it is profit. Then if it is going to appear in the credit side of the revaluation account, then it is loss. So we have to share it among the old partners in their old profit sharing ratio. Case if the revaluation profit is what is going to happen, then revaluation account debit to old partners capital. We have to share that profit into old partners capital. Okay, in their old profit sharing ratio. Okay, if in the case of loss, what we have to do, we have to reverse this journal entry, old partners capital account debit to revaluation account in case of loss. Now this is how we are how we prepare a revaluation account. Be able to see that. Then comes the other method, that is without changing the balance sheet values. So under this method, the values in the balance sheet will not change. That after preparing, in this case we will prepare a memorandum revaluation account, and thus the values of the balance sheet does not change. So let's see how it is done. Record increase or decrease in the value of assets and liabilities as discussed. So it is just like before only, like in the past, like the earlier we told how we are going to prepare a revaluation account. The same logic or same concept applies here too, but here there is a new point. Let's see that. Share the profit or loss on revaluation among the all partners in their all profit sharing ratio. That is also included in the earlier way how we did how we prepared a revaluation account. Like the third point, reverse the increase or decrease in the value of assets and liabilities, and that is what it makes this different from the revaluation account. This makes the memorandum revaluation account differ from the revaluation account which we earlier discussed. After reversal, calculate profit or loss, and this profit or loss have to be shared among the old partners in their new profit sharing ratio. Old partners, this profit or loss, whatever it is, should be shared among the old partners, including the new partner. Now let's see how it is prepared. The same way, the first half is done on the same way like how we prepared a revaluation account only. The other half is the reversal of the first half only. That is what we debited we credited, and what we credited we debited. That is what happened. And then profit or loss, whatever it is shared among all partners in their new profit sharing ratio. Even the new partner will get a share. Fine. So this is how we prepare a memorandum revaluation account. There are one or two questions in our study mat which requires the preparation of memorandum revaluation account. So that is why we are discussing this. Fine. Now let's discuss illustration number 1. X and Y are partners sharing profit as 4:3. Old profit sharing ratio is 4:3. Z join as a new partner. So Z is a new partner. The new profit sharing ratio between X, Y and Z was agreed to be 7:5:3. So they have already given us a new profit sharing ratio directly, so there is no need for us to find the new profit sharing ratio. Let's see what in the question they are asking. The goodwill of the firm was valued at rupees 84,000. So we already told that will be a lots of methods in order to value goodwill, but in this question they have given us the goodwill of the firm directly. Okay, so that is 84,000. So let's see what they are about to ask. But Z could not pay any amount for goodwill. Okay, so Z was not able to pay any amount for goodwill. So what we are going to do in this question? Fine. So that is the question. They have given us the old profit sharing ratio, new profit sharing ratio, and they have also given us the goodwill of the firm, 84,000 rupees, 84,000, and Z could not pay any amount as premium. Okay, so now let's see how this question is being solved. First, calculate Z's premium. Let's see how Z's premium is calculated. It is already given in the question. That is, new profit sharing ratio is what? 7:5:3 is a new profit sharing ratio. In that, Z's portion is what? 3/15, right? So we are just applying this 3/15 onto this 84,000, and then we'll get a portion. So that is 16,800. So the amount what Z has to bring as premium is 16,800. Okay, fine. Okay, I hope you remember what I read before. That is, when a partner is newly admitted, the goodwill of the firm will be valued by using any method. So that is what they have given in the question. They have already given us the value of the firm. Step 2, calculate sacrifice made by X and Y. So let's calculate the sacrifice which is done by the old partners. Just subtract the new profit sharing ratio from the old profit sharing ratio, and then we'll get the sacrificing ratio of what? X and Y. Fine. So they have given us the sacrificing ratio, that is 11:10. 11:10 is the sacrificing ratio of X and Y. Okay, so fine, we got sacrifice ratio. What we are going to do? They have told us in the question that Z was not able to pay the amount of goodwill premium. So what we are going to do? We have to raise that, right? We have to raise. There is no value. If the new partner was not able to bring the goodwill, then that goodwill have to be raised. That particular amount have to be raised. So we are just raising that amount. 16,800 has to be raised, right? So that should be debited to the Z's capital. Z was the person who could not bring that, right? So Z's capital have to be debited. So Z's capital account debit to X capital, old partner's capital. Old partner's capital have to be credited to X's capital account, to Y's capital account. So you might not able to do this question right now, because the journal entry, you will be asking me why we are doing this, but it is discussed later, that you will be able to see the treatment of goodwill journal entries, right? So in that we'll discuss this particular portion. So then you will understand why we passed this journal entry. Okay, so in this question, Z was not able to pay the premium, so we have to raise the premium. We have to raise the goodwill premium, and this is the journal entry which we used to pass. That is, we will debit the new partner's account, capital account, and then we'll credit the old partner's capital account. This is the journal entry we have to pass if the new partner is not able to bring the portion of premium or the entire premium. Okay, so I guess this is clear to you. Illustration number 1 has to be discussed after discussing all the journal entry which comes under the head treatment of goodwill. Okay, so no worries, you will be able to understand that later in the next video which I am going to upload. And yes, thank you for watching this video. Thank you for choosing this video. I have my own limitations in English. Hope I will do better in English in the future, so let it be a stepping stone for me. Thank you for supporting me. Thank you for watching, and rock your studies.